Well, historically, if you just go back and, look for the last 100 years, if you just would simply put your money in the S&P 500 and hold it for the long term, not for 1 year, not even for 3 years, because you brought up a good point. This year, last year, 25% gain, including dividends, right? Maybe a bit more. But what about in the dot-com bubble burst, right? So the SEC does have down years. It has up years. But if you look at the long-term chart over any 10-year period, and then as you go to 20 years and 30 years, if you simply buy it and hold it, you will outperform 99.9% of all the hedge funds, mutual funds out there, paying virtually no fees, no expenses attached to it now because there's easy ways to buy it, as I lay out in the book, right? And the bottom line is that, everybody has to look at the question, okay, I make a certain amount of money, I spend a certain amount, I have some left over. Where do I invest that? And if you think like you're going to watch CNBC and get sucked into buying this stock, selling this stock, trying to time the market, it just doesn't work. So over the long term, the S&P is proven to be the most lucrative investment for the average person.
The average holding period a year for the stock market is 6 months, whereas back in the day in 1950, a typical investor held onto their shares for 8 years on average. Now that stat alone is remarkable, and I'm telling you now that's the reason everyone loses money on the stock market. This huge decline in holding period is due to technology advances where you can buy and sell with ease in the matter of seconds on your phone. Also, it's because of the media and the effect it has on investors. It causes fear and panic in the markets, which causes people to do irrational things.
There's a few people in the world that can beat it consistently. There's a few money managers. Guess what? They're not going to take your money. So they are like the rock stars of the so-called hedge fund world, right? And then you have all the other people who kind of suck at what they do, but they bathe in the afterglow of these superstars. So you think, oh my God, give money to a hedge fund or mutual fund. They underperform.
As Jordan stated, if hedge funds and professional money managers can't beat the market, how the hell do you think you have a chance? But I can guarantee you people won't listen to this advice. And you know why? It's how humans are set up. They are greedy and people want to get rich quick. They are short-term focused, not long-term focused, and the stock market is a long-term game. That's where you'll achieve the best results. As Jordan Belfort explains, the S&P 500 consists of the biggest 500 US publicly traded companies. Yes, these big companies, Apple and Microsoft for example, will most likely not be the biggest in the next 100 years or so. However, that doesn't matter because the way the S&P 500 operates is they change their ownership dependent on company performance. And over the last 100 years, they have done this extremely well, and I strongly believe they will continue to do so. Jordan Belfort goes on to talk about his experience with Wall Street, and how you have the good side, where they make companies go public with IPOs, construct deals being mergers and acquisitions, which all in all helps drive the overall US economy. However, then you have the dark and evil side of Wall Street, where they create bubble after bubble and are extremely greedy/corrupt. I mean, look at the biggest scammer gone down in history. At the time, he was a massive part of Wall Street. In fact, he was the founder of the NASDAQ itself.
Where you tried to convince people to buy individual stocks and you say, the money's coming, the money is going to do it, this is it, put it in here, this thing's going to double, it's going to triple, is what you learned and eventually went to prison for. What's driving you now because you know the other side, and the other side doesn't want people to understand intrinsic value or price to earnings ratios?
The answer to that is yes. I've seen the seedy underbelly of Wall Street. And here's the thing. Wall Street is necessary. They create massive value. We need Wall Street for the economy to function. So the way you take advantage of that and get all the best things that Wall Street creates is by simply buying the S&P, holding it, and if you can make little contributions along the way, you can take a small amount of money and over the long term turn it into a giant nest egg. But you're not going to do that by buying individual stocks and trying to time them out. So every investor should do this.
Most people argue that property is a less risky and better investment than investing in the stock market. However, when it comes to the S&P 500, they are completely wrong. Every investment carries risk. The amount the S&P 500 has delivered in return compared to the property market is outstanding. And for anyone saying the property market is bulletproof, they are lying to themselves. Just look back at 2008 and have a rethink. No investment carries no risk. Now I know what you're thinking. Why should I take advice from a man that went to prison for money laundering and securities fraud? However, this advice doesn't stem from Jordan Belfort. It has historically been great advice to take, and one man that preaches this advice constantly is one of the best investors to ever live, Warren Buffett himself.
And that is to consistently buy an S&P 500 low-cost index fund. Keep buying it through thick and thin, and especially through thin, because the temptation gets, when you see bad headlines in newspapers, maybe to say, well, maybe I should skip a year or something. Just keep buying it. American business is going to do fine over time. So you know the investment universe is going to do very well. The Dow Jones Industrial Average went from 66 to 11,497 in 1 century. And then since that century has ended, it's more or less doubled again. American business is going to do well. The trick is not to pick the right company. It's to be, because most people aren't equipped to do that, and plenty of times I make mistakes on that. The trick is to essentially buy all the big companies through the S&P 500, and to do it consistently, and to do it in a very, very low-cost way, because costs really matter in investments. If returns are going to be 7 or 8%, and you are paying 1% for fees, that makes an enormous difference in how much money you have on retirement.
So there you have it. If you want to listen to this advice, you're going to do very well. However, if you want to continue to speculate and gamble on cryptocurrencies that are essentially worth nothing and produce no value, be my guest. We will see who is the winner in the end. I'd like to thank everyone for watching this video, and if you enjoyed the video, subscribe for more content going forward and to stay up to date with market news, investing ideas and the like. It's been a pleasure. Until next time.